Good day and welcome to our webinar. My name is Tshepo Sebolai. I am from the Financial Advisers and Intermediaries Department at the FSCA. The purpose of today's webinar is to reiterate the insurance requirements for FSPs. So today I'm joined by my colleague Ntuli, who will be taking us through the presentation. Over to you, Nhlanhla.
Thank you, Tshepo. Hence, my colleague has already mentioned, in today's session, I will be taking you through the insurance requirement for FSPs. In terms of Section 13 of the General Code of Conduct for Authorized Financial Services Providers and Representatives, it requires or mandates that financial services provider must maintain an appropriate insurance coverage. The Section 13 of the General Code of Conduct is not applicable to the following: to a representative, to an insurer as defined in the Insurance Act 18 of 2017, as well as to a bank as defined in the Banks Act 94 of 1990. There are particular FSPs that have been exempted from Section 13 of the General Code of Conduct. These include Category 1 FSPs rendering financial services in respect of long-term insurance subcategory A and of friendly society benefits. The exempted FSPs rely on FSCA Phase Notice 110 of 2017. This notice was then extended by FSCA Phase Notice 69 of 2020, which expired on the 31st of August 2022. Then extended by FSCA Phase Notice 83 of 2022, which expired on the 31st of August 2024. And the recent notice being FSCA Phase Notice 60 of 2024, which will expire on the 31st of August 2029. FSPs should make use of Board Notice 123 of 2009. This notice provides guidelines for the implementation of the insurance coverage in respect of different categories for FSPs. The types of insurance covers that FSPs can choose from includes the following: the professional indemnity insurance, the fidelity cover, as well as the guarantees. The professional indemnity coverage is commonly referred to as professional liability insurance. This is an essential insurance policy that safeguards financial service providers against claims stemming from professional negligence, errors, or omissions in delivering of financial services. This coverage offers financial protection in instances where clients incur losses due to insufficient advice, administrative mistakes, or breaches of fiduciary responsibility by an FSP or its representatives. The other form of coverage is the fidelity cover. The fidelity cover covers the dishonest act by employees or its representatives. This is a form of insurance designed to protect businesses and community organizations from financial losses caused by employee theft, fraud, or dishonesty. This coverage addresses losses of money and property as a result of action such as embezzlement or misappropriation of funds by individuals entrusted with the financial responsibilities. The other form of insurance is the bank guarantee. The bank guarantee are alternative to insurance coverage. This is a type of policy in which an insurer agrees to cover financial losses if a contractor does not meet its contractual obligations. In this arrangement or in this agreement, the insurer serves as a guarantor, stepping in to provide payments or cover costs in the event that the principal defaults on the initial arrangement or initial agreement. This act by the guarantor offers financial safety net for employers as well as for clients. The following is the insurance requirement in respect of different categories of FSPs. For Category 1 or Category 4 FSPs that does not receive or hold customer funds or client assets, must have a suitable guarantee of at least a minimum of 1 million, or a suitable professional indemnity cover of a minimum of at least 1 million. For Category 1 or Category 4 FSPs that hold customer funds or receive client funds or customer assets, must have a suitable guarantee of a minimum of at least 1 million, or a suitable professional indemnity cover and fidelity insurance of at least 1 million. For Category 2 FSP that does not receive customer funds or hold client assets, must have a suitable guarantee of a minimum of at least 1 million, or a suitable professional indemnity cover of a minimum of 1 million. For Category 2 FSPs that receives or hold customer funds or client assets, must have a suitable guarantee of a minimum of at least 5 million, or a suitable professional indemnity cover or fidelity insurance of a minimum of at least 5 million. For Category 2A FSPs that does not receive or hold customer funds or client assets, must have a suitable guarantee of a minimum of at least 5 million, or a suitable professional indemnity cover of minimum of 5 million. For Category 2A FSPs that receives or hold customer funds, must have a suitable guarantee of at least of a 5 million, or a suitable professional indemnity cover and fidelity insurance of a minimum of at least of a 5 million. For Category 3 FSPs that does not receive or hold customer clients, must have a suitable guarantee of a minimum of at least of a 5 million, or professional indemnity insurance cover or fidelity insurance cover of at least of a 5 million. The insurance requirements serve for multiple purposes, which amongst them include the following. The first is client protection. The insurance coverage ensures that client can recover losses resulting from professional negligence and by FSP and its representatives. It also provides financial recourse when FSP cannot meet its financial obligations. This ensures that there is maintenance of confidence within the financial services industry. The insurance coverage also aims to ensure that there is industry stability. It aims to ensure that there is industry stability by reducing systematic risk from FSP failures. These systematic risks form part of the total risk caused by factors that are beyond the FSP or that are beyond the control of any financial service provider. Such systematic risks have the potential to trigger a collapse of a financial institution of any FSP. By effectively insuring against such risk, FSPs ensure that its clients are safeguarded at all times. And lastly, the insurance coverage aims to ensure that there is regulatory compliance. It aims to ensure that there is regulatory compliance by ensuring that financial service providers meet the minimum prudential requirement, and also by ensuring that FSP adhere to the minimum standard and regulation set by the authority. This will ensure that FSP are able to absorb shock and also are able to ensure the safety of clients. This will also ensure that there is maintenance of stability within the financial system. For example, FSP must be able to demonstrate that they are able to meet the solvency capital requirements. It is important to take note that the insurance requirement coverage must be in place before an FSP can commence any of its financial service activities. Therefore, meaning that an FSP cannot commence any financial service activities without having the insurance cover in place. The existing FSP must maintain the continuous cover, meaning that the cover of the FSPs that are already in place, they must ensure that such cover does not lapse. It is also important to note that the PI cover is subject to annual renewal and the FSP is subject to reporting obligation to the authority. Some of the best practices from the FSP includes the following. The FSP has to annually assess the coverage adequacy. By effectively assessing the coverage adequacy, the FSP will not underinsure or overinsure its risk at hand. For example, FSPs have to be able to compare between the inherent risk as well as the residual risk. By comparing between the inherent risk and the residual risk, the FSP is able to insure against the remaining risk, which is the risk after the control measures have been put in place. FSPs also have to ensure that they maintain a comprehensive insurance record. This will also enable the FSP to submit the insurance request to the authority when requested, or by the time the authority has requested such. FSPs also have to set up annual reminders. Such annual reminders will assist the FSP that by the time the cover is about to lapse, the FSP will be aware that the cover is about to lapse, and they will be able to source quotes from different insurers, and they will be able to compare such quotes from different insurers and choose the most cheapest quotes from such approved insurers. This will also ensure that there is cost management within the FSP. The FSPs also have to ensure that they establish a clear claims procedure. It is also important to note that FSP must maintain the required insurance coverage throughout the authorization period of the FSP. This simply means that the cover cannot lapse or be cancelled without an immediate replacement. Also, FSP also have to take note that failure to maintain the insurance coverage may result into a suspension or withdrawal of such an FSP license. In conclusion, we would like to emphasize that the insurance requirements are fundamental for ongoing operation of FSPs. These requirements or this insurance coverage will ensure that clients are protected. They will ensure that they support industry stability. They'll support in the industry stability, and it will also ensure that there's regulatory compliance within the industry. That will be the end of today's session. Thank you.
Thank you very much, Nhlanhla, for the presentation. This brings us to the end of our webinar today. And we also like to thank our viewers for watching the webinar. Goodbye.